Hey everyone, and welcome back to the Finance Meister YouTube channel. Ever wondered why so many traders struggle to make money? It's usually not because their actual trading strategy is bad. Most of the time they are simply using the wrong strategy at the wrong time because they don't understand the market's current mood. Actually, the market behaves in four distinct ways. You have an uptrend, a downtrend, a sideways or ranging market, and finally, a choppy, messy market. Each of these phases has its own personality, and you need a different game plan for each one. In this video, we are going to break down how the market flows, how price moves, how to read the structure, and the exact trading setups you can use for every single market condition. If you want to level up your trading game and stop losing money on bad setups, make sure to hit that subscribe button and turn on notifications so you never miss our weekly guides. Let's jump straight into it, starting with a trending market. A trending market is simply when the price is steadily moving in one clear direction. In an uptrend, the price climbs by making higher highs and higher lows. The key here is that the market respects the previous swing low. What this means is that as the price pushes up, it might pull back a bit, but it won't drop below the point where the last upward move started. Once the price breaks above the previous high, the lowest point of that pullback becomes our brand new swing low. As long as the price stays above this new swing low, we have a bullish bias, meaning we are only looking for buying opportunities. But what if the price suddenly drops and closes below that swing low? That is our warning sign. It tells us the buyers are losing their grip, and the uptrend might be over. A downtrend is just the exact opposite of this behavior. The price keeps falling, making lower lows and lower highs. Here, the market respects the previous swing highs. As long as the price stays below the last swing high, we keep our bearish bias and look strictly for selling opportunities. To understand how the market transitions, we have to look at the break of structure. In an uptrend, every time the price breaks above the previous high with a strong, solid candle close, we call this a break of structure, or BOS. It's a green light showing us that buyers are still in control and the trend is continuing. Once this happens, we mark the start of that breakout move as our new swing low. Now we have a trading range to work with. We expect the price to pull back, get rejected somewhere inside this range, and then push back up toward the previous high. But what if the price fails to push higher and instead drops to close below our swing low? This is what we call a change of character, or CHoCH. This is a major warning signal that the market direction is shifting, buyers are losing control, and it's time for us to start looking for sell setups instead. Another major clue for a reversal is a sudden shift in momentum. Imagine the market is climbing with massive, strong green candles, which shows huge buying pressure. If out of nowhere the market suddenly drops with giant red candles, it tells us that sellers have aggressively stepped in. This sudden change in candle size is a big hint that a reversal is coming. While trending markets are the absolute best and most profitable times to trade, not all trends look the same. An ideal trend is beautiful, clean, and incredibly easy to read because the pullbacks are gentle and the price reacts perfectly at key levels. On the other hand, an imperfect trend is messy. You will see deep, scary pullbacks, fake trend changes, and confusing price action. To keep yourself safe in messy trends, you have to understand the traps that the market sets for you. There are three common fakeouts you need to avoid, starting with the failure to continue. Sometimes the price drops slightly below a swing low but can't hold that lower level and immediately shoots back up. If it then breaks above the previous high, it means the trend is still bullish, and that downward move was just a fake signal. The second trap is the liquidity hunt. If there is a lot of money or liquidity sitting just below a swing low, big players might briefly push the price down to grab those stop losses and then immediately reverse the market back up. This wasn't a real trend change, it was just a trap to clean out retail traders. The third trap is fair value gap mitigation. If there is an open gap in the price, which we call a fair value gap, sitting just below the swing low, the market might quickly dip down to fill that gap and then instantly bounce back up to continue the uptrend. This dip is just a healthy reaction, not a structure break. Now let's talk about how we actually trade these moves in a trending market. We can divide our strategies into continuation setups and reversal setups. The first setup is buying the pullback. When the price breaks structure to the upside, don't FOMO in at the very top. Instead, be patient and wait for a pullback. Draw your Fibonacci tool from the swing low to the temporary high. The best plan is to wait for the price to drop back down into the 61.8% Fibonacci level or into a fair value gap. Once you see the price get rejected there, enter the trade and target the previous high. It's one of the safest ways to trade. By the way, if you're getting value from this breakdown so far, please take a second to hit that like button. It really helps the algorithm show this video to more traders just like you. And speaking of taking your trading to the next level, if you are looking for a reliable prop firm with fast payouts, you should definitely check out Funded Next. They are a major player in the industry, offering both futures accounts and CFDs all in one convenient platform. They have challenge accounts ranging from $5,000 all the way up to $200,000. And they even offer instant funding so you can skip the challenge phase altogether if you want. Even better, our community gets an exclusive 7% discount plus a 120% account refund reward if you sign up using our special link in the description down below. Go check it out. The next setup is the break and retest. In a bullish trend, wait for the market to form a double top, which is a level it struggles to break. Once the price finally breaks above this resistance, wait for it to come back down to test that same level from above. If it holds and you see a candle with a long lower wick showing rejection, enter the trade and put your stop loss just below that zone. Similarly, in a bearish trend, wait for the price to form a double bottom. Once it breaks below, wait for it to rise back up and retest that level as resistance. If a strong bearish engulfing candle forms, take the sell and place your stop loss right above the zone. Now let's talk about reversal strategies, starting with the change of character entry. After a long uptrend, don't just jump into a sell immediately. Wait for a clear change of character. We want to see one or two strong, heavy red candles breaking below the last swing low. Once that happens, look for any fair value gaps left behind. Set a limit sell order at the start of that gap, put your stop loss safely above it, and target the next key support level below. Another high probability option is the inversion fair value gap and liquidity grab. This is a very powerful setup. When the price sweeps above a key high to grab liquidity, but immediately drops and leaves behind an inversion fair value gap, it tells us that momentum has completely shifted. The market took the buyer's liquidity, and now it wants to target the seller's liquidity on the downside. Combining these two elements gives you a highly reliable trade. While trending markets are great, the reality is that the market spends a massive amount of its time just moving sideways. If you only trade trends, you'll be sitting on your hands most of the year. That's why learning to trade a range is crucial for consistency. A ranging or sideways market happens when the price stops making higher highs or lower lows. Instead, it gets trapped, bouncing back and forth between a very clear high, which acts as resistance, and a clear low, which acts as support. A simple rule of thumb to spot a range is to look for at least 2 clear rejections from the bottom support line and 2 clear rejections from the top resistance line. Once you see this happening, you can safely say the market is moving sideways. Just remember that the cleaner these levels look, the easier and safer they are to trade. When it comes to ranging market strategies, the first setup to watch is the third touch. The third time the price approaches a support or resistance level is often the golden opportunity. But don't just enter blindly the second the price touches the line. Wait for confirmation. Look for a rejection candlestick wick or a strong, decisive candle moving away from the zone. Once you see that reaction, you can enter the trade. The second setup is the range break and retest. Eventually, the range will break. If the price breaks above resistance, that old resistance now becomes new support. Wait for the price to come back down, test the level, and show a strong rejection before buying. If it breaks below support, wait for it to retest that level as resistance. Look for a rejection and take the sell. Sometimes the price breaks out of a range but immediately fails and drops back inside. This is a failed breakout, and it traps breakout traders, causing them to lose money. To avoid this issue, we use the inside bar strategy. An inside bar is a candlestick that is completely swallowed up by the range of the previous candle, which we call the mother candle. This pattern represents a temporary pause or indecision in the market before a big move. We trade inside bars as continuation setups. First, wait for the price to break out of the range, for example, breaking above resistance. Instead of buying immediately, wait to see if an inside bar forms. This confirms the market is taking a quick breath after the breakout. Once the price breaks out of that inside bar's high, we enter our buy position. This confirms that buyers have stepped back in with real strength. Place your stop loss safely below the mother candle and target the next key historical level. This single step will save you from countless false breakouts. Finally, we have choppy markets. A choppy market is a total mess. The price moves completely randomly, with no clear trend and no clean range. It just whipsaws up and down, printing false signals everywhere. The absolute best strategy in a choppy market is patience. Do not trade. Your goal here is not to make money, but to protect your capital. Simply sit back and wait for the market to transition back into a clean trend or a solid, readable range. Learning when not to trade is just as important as knowing when to trade. Keeping your cash safe during choppy days is what separates professional traders from beginners. I hope this video brought some massive value to your trading journey today. If it did, please make sure to like, comment with your thoughts, and subscribe to the channel for more straight-to-the-point trading content. Take care of yourselves, manage your risk, and I will see you all in the next video.